There's a number that your life is worth. Not philosophically, not spiritually, literally, a number. Calculated by someone in an office building you've never been to using a methodology you've never seen that determines exactly what your death, disability, or kidnapping is financially worth to the people and institutions connected to you. You've never met this person. They've never met you, but they've looked at your age, your profession, your zip code, your medical history, your driving record, and approximately 40 other variables, and they've produced a number. That number determines what you pay for insurance. It determines whether you get coverage at all. It determines in some cases whether someone negotiating for your release from a kidnapping situation will pay the ransom or not. This is the actuarial profession, not the version they describe in the career brochures, or the one about analyzing data to help companies manage risk. The version that actually exists at every level of it, from the person denying your mother's life insurance claim on a technicality to the person who turned a California earthquake into a financial instrument that hedge funds can bet on. The math is clean. The human consequences of the math are complicated. Here's what it actually looks like from the inside. Level 1, the claims analyst. $52,000 per year, entry level. Your job title says analyst. Your actual job is to find reasons to say no. The training is 3 days. Day 1, systems. How to navigate the claims management software, how to pull a policy file, how to read an application. Day 2, policy language. The specific, precise, deliberately complex language that insurance contracts use and what it means when a claim comes in that sits near the edge of what the policy covers. Day 3, what your supervisor calls documentation review, which is the process of reading through the supporting materials a claimant submits and looking for anything that doesn't match the application. Anything that doesn't match the application is called a material misrepresentation. A material misrepresentation is grounds for denial. What counts as material is where it gets interesting. Your first denied claim is a life insurance payout on a 58-year-old man named Gerald Kowalski who died of a heart attack in March. His wife submitted the claim. The policy pays $500,000. You pull the application from 6 years ago. Gerald listed his weight as 195 pounds. His medical records, which you request as part of the review, show he weighed 214 pounds at his last physical, which was 8 months before he applied, 19 pounds. On a life insurance application from 6 years ago, you flag it. Your supervisor reviews it. The claim is denied on the basis of material misrepresentation in the application, specifically inaccurate health information that may have affected underwriting. Gerald's wife calls the claims line 17 times over the next month. You take 3 of those calls. She's 56 years old. She explains that Gerald didn't remember exactly what he weighed when he filled out the form. She explains that they have 2 kids still in college. She's not angry on the calls, which is somehow harder than angry. She's just trying to understand. You explain the process. You explain the appeal option. You explain that the decision was made based on the documentation in the file. You don't explain that the documentation review process is specifically designed to find these discrepancies. You don't explain that your department's performance metrics include a denial rate and that your supervisor's quarterly review tracks whether that rate is being maintained. You don't explain that the $500,000 your company didn't pay to Gerald's wife is $500,000 that goes somewhere else in the balance sheet. She files an appeal. The appeal is denied. You move to the next file. By the end of your first year, you've processed 847 claims. You flagged 112 for denial review. Of those, 73 were denied in full or in part. You don't know what happened to most of the people behind those 73 files after the denial. The file closes and you move to the next one. This is the job. You tell yourself that the policy language is what it is, that you didn't write it, that your job is to apply it, not to make it, that most of the denials are legitimate under the terms of the contract the person signed. Most of this is true. You hold on to most. Level 2, the catastrophe modeler, $95,000 per year. You don't see people anymore. You see probability distributions. The hurricane that killed 1,800 people is a data point in your loss model. Your desk has 3 monitors. The center one runs RMS, Risk Management Solutions, the industry-standard catastrophe modeling software. On any given day, it's processing storm tracks, seismic data, flood zone mapping, or wildfire spread models across geographic areas that contain millions of people and hundreds of billions of dollars in insured property. Your job is to tell the company what it's going to cost when the bad thing happens, not if, when. This is the first thing catastrophe modeling teaches you that changes how you think about the world. Disasters aren't surprises, they're scheduled events that we don't know the exact date of. A major earthquake on the Cascadia subduction zone, the fault running off the Pacific Northwest coast, isn't a hypothetical, it's a certainty. The scientific consensus is that there's approximately a 37% probability of a 8.0 plus magnitude earthquake on that fault within the next 50 years. The last one in 1700 produced a tsunami that struck Japan. The next one will hit a region that has 4 million more people in it than it did in 1700. You've modeled this event. The modeled insured loss, just the insured portion, not total economic damage, is somewhere between $80 billion and $340 billion depending on the specific scenario. The range is wide because the range is honest. You don't know where on the fault the rupture starts or how long it lasts or what time of day it happens. The model gives you a distribution of outcomes. You report the distribution. What happens next is where your work leaves clean math and enters the real world. The company uses your models to set rates. In Florida, where hurricane risk is well understood and increasing, sea surface temperatures are warming, storms are intensifying. The 2004 and 2005 seasons produced losses that the previous generation of models hadn't anticipated. The rate changes that your work supports have been significant. In some coastal counties, homeowners' insurance premiums have tripled or quadrupled in the last decade. You didn't set those rates. You provided the loss projections that the pricing team used to set those rates. The distinction is real, and it matters to you professionally, and it matters less to the 74-year-old woman in Sarasota who can no longer afford to insure the house she's lived in for 40 years and is now making decisions about whether to sell or go uninsured and hope. The model has a field for expected losses. It doesn't have a field for displacement. You've thought about this. You've had the conversation with colleagues at industry conferences. The general conclusion is that the risk is real. The pricing reflects the risk. And if the homes shouldn't be built where they're built, that's a land use policy question that's outside the scope of actuarial practice. This is technically accurate. You've repeated it enough times that it mostly satisfies the part of you that asks. Level 3. The specialty lines. Underwriter, $180,000 per year. You insure things that shouldn't be insurable. You are very good at deciding what a human body part is worth. The call comes from a talent agency in Los Angeles. They want to insure a client's hands. The client is a concert pianist, you can't say who, confidentiality, who has a European tour starting in 4 months and is scheduled to record 2 albums next year. The agency wants to know what it would cost to insure against an injury that prevents performance. This is, in the language of the industry, a personal accident policy with a specific performance endorsement. The underwriting process requires you to determine what is the financial value of this person's ability to play piano. The answer isn't arbitrary. You build a model. Career earnings projection based on historical performance fees, recording royalties, touring revenue. Probability of injury. You request medical history, look at actuarial tables for hand injuries and professional musicians, factor in the specific demands of concert performance, expected loss given injury, which depends on severity, recovery timeline, whether the career can resume, and at what level. You produce a number. The number has a premium attached. The agency pays the premium. If the pianist's hands are injured, the policy pays. You also write stranger things, a major league pitcher's throwing arm, a model's legs. You have to be careful here because the policy language around what constitutes a covered loss versus an uncovered lifestyle choice creates situations that require very specific documentation. A television host's voice, a chef's sense of taste, which is a coverage form your firm created in response to a specific request and which required 3 months of legal review because the loss measurement methodology, how do you prove and quantify a reduced sense of taste, has no established industry standard. These policies come with behavioral requirements. the pitcher can't ski. The model has a list of approved and prohibited physical activities. The pianist's travel is restricted to commercial airlines and business class minimum because the turbulence risk profile of private aviation in certain categories is higher, and the hands are the insured asset. You are writing contracts that govern how people live their lives, in detail, in exchange for financial protection against very specific bad outcomes. Most of your clients find this normal. A few find it unsettling. The ones who find it unsettling are usually the ones who haven't yet thought of themselves as an asset. Once you've written the policy, they start to. Level 4. The K&R Specialist Kidnap and Ransom Insurance. The product nobody knows exists. The product that every multinational corporation quietly carries, K&R, Kidnap, Ransom, and Extortion Insurance, is one of the most sensitive products in the insurance industry. Policyholders are instructed not to disclose that they have it. The reason is straightforward. If kidnappers know a target's employer carries K&R coverage, the ransom demand goes up because they know there's institutional money behind the negotiation. Your clients are corporations with executives operating in elevated risk environments, energy companies with personnel in West Africa, mining operations in South America, financial institutions with regional offices in parts of Southeast Asia where express kidnapping, grabbing someone for a few hours to drain their bank accounts, is common enough to have a category name. The policy covers ransom payments, negotiation costs, medical and psychiatric care for the victim and their family, crisis response fees, and loss of income during the event. It does not cover under any circumstances the cost of a ransom that the policyholder paid before notifying the insurer because unprompted ransom payments incentivize further kidnappings and create a market dynamic that makes everyone less safe. This is the policy language. In practice, when a CFO's family member has been missing for 18 hours and someone calls to give instructions, the company does not always remember to call the insurer first. The cases you work are handled by crisis response consultants, typically former intelligence or law enforcement professionals, who are paid by the policy. Your job is the financial architecture, understanding the policy terms, managing the reserve, authorizing expenditures as the situation develops, and ultimately determining the settlement. The hardest cases are the ones where the actuarial logic and the human logic diverge completely. You had one. A mid-level manager, not a senior executive, the kind of employee that a company genuinely cares about, but whose economic value to the organization, calculated precisely, is not enormous. Kidnapped in a region where the going rate for this kind of event had been between $50,000 and $150,000, the demand came in at $800,000. The crisis consultant's assessment, the demand was negotiable. The realistic settlement range was $200,000 to $350,000. The policy limit for this individual's coverage tier was $500,000. There was room, but the negotiation takes time. Negotiations in this context always take time because time is a pressure tool on both sides. Every day that passes, the family is in crisis. The company is managing its own crisis communication. You are sitting in calls at 11 p.m. listening to the consultant's assessment and thinking about the reserve. The man came home after 17 days. The settlement was $275,000. He had a stress response that required 6 months of treatment. His marriage didn't survive the following year, which isn't unusual in these cases. The file closes. You write the settlement report. You add it to the case data that improves the model for the next policy in that region. You think about them sometimes, not often, but sometimes. Level 5, the catastrophe bond structurer. You've turned the apocalypse into a financial product. The math is elegant. What it represents is something else. A catastrophe bond, cat bond in industry shorthand, is one of the stranger things that exists in modern finance, and you work in a market full of strange things. Here's how it works. An insurance company has exposure to a catastrophic event, say a major earthquake in California. If the earthquake happens, the insurer pays out potentially billions of dollars in claims. To manage that exposure, the insurer issues a cat bond. Investors buy the bond. They receive above-market interest payments, the risk premium, for as long as the catastrophic event doesn't occur. If it does occur, and the losses exceed a specified threshold, the investors lose some or all of their principal, which the insurer uses to pay claims. The investors are, in simple terms, betting that the earthquake doesn't happen. The insurer is buying insurance on their insurance. The structure transfers risk from an institution with concentrated exposure to capital markets with distributed exposure. This is, from a financial engineering perspective, genuinely elegant. The structure works. It has functioned exactly as designed in multiple events. It has made the insurance market more stable and more capable of absorbing large losses than it would be otherwise. You structure these instruments. A typical deal takes 4 to 6 months from initial structuring to market. You work with the catastrophe modelers, you were one earlier in your career, to specify the trigger conditions precisely. You work with lawyers to draft the indenture. You work with investment banks to place the paper with institutional investors, pension funds, hedge funds, family offices, dedicated cat bond funds that have decided this risk-return profile belongs in a diversified portfolio. The investors receive your offering memorandum. It contains the catastrophe model outputs, the trigger definitions, the probability of loss analysis. It is a very good document. It is also, at its core, a document that describes the financial terms on which a group of institutional investors will profit from the non-occurrence of an event that, if it did occur, would kill people and destroy homes. The earthquake that the California cat bond is protecting against, the one in your current deal, 5.5-year term, $400 million in notes, 8.2% coupon, has a modeled annual probability of triggering the bond of approximately 2.3%. The expected loss for investors is real but manageable within a diversified portfolio. If the earthquake happens, the $400 million goes to pay claims, the investors lose their principal, the insurance company can pay out. If the earthquake doesn't happen, which 97.7% of the time in any given year it won't, the investors collect 8.2% and the principal is returned. You had a conversation once at an industry conference with a portfolio manager who runs one of the larger dedicated cat bond funds. He described his work as providing essential liquidity to the reinsurance market and taking on risk that the insurance industry cannot absorb alone. Both of these things are true. He also, after 2 drinks, said, "We're essentially selling lottery tickets in reverse. The catastrophe is the jackpot, but we're the house." You thought about that for a while. The current deal price is next week. The order book is oversubscribed, meaning investors want more of the paper than is available. Demand for cat bonds has been strong. The risk-adjusted returns are attractive relative to other fixed income alternatives in the current rate environment. You finalize the final term sheet. You send it to the printer. Somewhere in California, 40 million people are living on top of a fault system that has been building stress since 1906. They are not thinking about this. You are not thinking about them. You are thinking about basis risk, the technical term for the difference between the modeled loss trigger and the actual loss that would be incurred in a real event, and whether the current trigger structure adequately protects your client. The math works. You close the document. If this is the kind of story you want more of, friends, subscribe. It keeps this going. Drop a comment if something here landed differently than you expected.